Good afternoon. This is Ken at Tortoise Capital with a review of the weekend trading report for May 18th, 2019. The market is in bullish normal conditions, so that favors the long side and supports swing trading. On an annual basis, using NDX 260, we are still overbought at 85 out of 100. So we're running up into some long-term and all-time high resistance levels that may be putting a cap on the upper limits. We have pulled back on a 10-day basis to the low end of neutral at 44 out of 100 using the 10-day NDX, and have actually rebounded off of that first harsh rebound. So there are some shorter term tactical opportunities, but got some long term resistance that must be overcome before we can have unqualified positive feelings about the upside. So this is much more of a tactical market and opportunity trading in the week ahead. With the political, economic environment being dominated by the China trade war, the potential for short-term volatility is certainly there. So we're going to be mindful of that by being judicious on our long side exposure and being prepared to rapidly hedge should volatility continue to develop. Looking at the market mosaic, price relative to the 200-day moving average is white bullish at 3%. So we are within about 1% of a sideways condition. So we've pulled back from those previous gains and are on the edge of a critical state where further weakness would not be surprising and would probably get reinforced if we saw any weakness. So this is a market that is in a vulnerable state right now in the short term, although everything long term points to positivity with a probable resolution of the China trade war and with unemployment numbers looking amazing. That the long-term prospects for the economy are good. Slope of the 50-day moving average is yellow neutral at 0.3. No new information there. The ADX is at 22.9, so neutral with respect to trend. The risk index is the 30-period moving average of the VIX divided by the 10-period. A score of 1.0 is the boundary between risk on and risk off. The current reading is at 0.83, so we are deep into risk off conditions. Now we take that score of 0.83 and compare it to the last 5,000 trading days, and we compute the risk z-score, which looks at the long-term average and the standard deviation. That z-score is minus 1.97, so we're almost 2 standard deviations of risk off given the volatility of the last 3 days of last week. You can see a 90-day histogram time series of that indicator, and you can see that there we are sitting right on 2 sigma below the long-term average. We have just completed a pretty violent downward move, which looks like the winter of this indicator, and so that does not favor long side trading. It does favor short-term bias neutral trading, so we are going to be very prepared to take advantage of intraday movements, and we are less likely to have any overnight risk, and we're going to try to get as much as we can out of these short, sharp directional intraday moves. And there's no directional bias because of the violent nature of that volatility. When that rolls over and starts to increment back up, then we begin to see opportunities for springtime swing trading begin to develop, but we're not at that stage yet. We need to see another 3 or 4 days of failure to fail further before we'd see this indicator roll over and give us some indications that routine swing trading could resume. So we're going to be very judicious about any swing trades we might take and really emphasize the shorter term trading while this indicator is in the red. Under the blended monthly rebalancing, the next reevaluation is due on or about 1 June. You can see right now the different holdings for May featuring a healthy dose of U.S. technology and U.S. real estate. And then the current leaders as of the close of business on Friday, still technology, real estate, and now treasuries have started to creep in as a response to the volatility and a flight to quality because of the increased volatility. ETF2, the The theoretical model is exposed at 40%, meaning that 6 of the 10 regions of the world are below their 4 month moving average. So this is not a time to be adding new money into the market, but to being judicious about the tactical opportunities that will abound. Quick look at some of the blended monthly rebalancing portfolios. There's ETF 13, about evenly split between buy and cash. It gets into a buy position if the price is above its 4 month, and cash if it's below its 4 month moving average. And you can see that the technology, treasuries, and real estate are in the lead right now. Latin America continues to get pummeled, I think, because of the Venezuelan crisis that shows no sign of abatement and is a real possibility for physical violence in the near term. So that's a human tragedy that didn't have to happen, and that's causing a great deal of weakness across Latin America. In ETF 32, I'm sorry, let me back up one. ETF 32 also evenly split between buying and cash positions. Technology, treasuries, utilities, real estate all continue to be the dominant forces here. And now you can see Brazil has joined Latin America in sympathetic sell-offs. These were regions that last year were by far the leading candidates on the long side. So you can see the volatility that's baked into the regional ETFs, and which provides swing traders and position traders the opportunities to play the business cycle as money cycles between regions of the world. Um, of interest is the PowerShares DB Agriculture. That has been horrible, but put in a pretty solid week with a plus 2.38%. So I would be investigating that for a potential short-term dead cat bounce momentum. Um, I'm not ready to go into that long term yet, but because that cycles, this may be an opportunity beginning to develop. Healthcare has also shown some signs of going from underperforming on the 3 and 6 month term to starting to outperform on the 1 month and the 1 week. So this may be healthcare's long-term turnaround. I would be willing to put money into that now for a longer-term swing with a wide stop to start playing that business sector cycling. That's enough improvement to convince me to start looking into it. Its counterpart in consumer staples, XLP, is kind of in the same position in the performance over 1 month and 1 week, but has less longer term pain to overcome. So that's easier to believe in it. However, if this really is a turnaround in healthcare, then the recovery potential is much greater. So we will look at that one on a chart, on a weekly charts to see what kind of RLFF opportunity there may be developing. In the Dow 30, you can see that Microsoft, Cisco, Verizon, McDonald's are all leading the way and had strong weeks and months. Cisco and Travelers especially solid. Cisco, we're going to take a look at that chart here in a minute. At the weekend, 3M, Dow, Boeing, Intel, these are all symbols that have been smashed over the last month. Boeing is this tremendous roller coaster ride, which offers some tactical opportunities, but still hasn't bottomed out yet, in my view, to start building long-term positions once more. In the ETF Max, or I should say the sectors, excuse me, also equally balanced. Technology, software, and innovative technology leading the way. Biotech showed a little bit of recovery, and that's consistent with the insight about healthcare. So that may be an additional area where business sector cycling may be pointing the way to a value opportunity. Oil and gas equipment put in a positive week at 1.82% there at the bottom of the stack, and has been absolutely murdered over the last 1, 3, and 6 months. So that may be a business that has buy it on sale, some opportunities as deep value plays. ETF Max, these are the outperformers in the stack of 500 ETFs that we are taking a look at, and you can see again dominated by technology and some energy in play here. Those look promising. In the world market model, you can see there's a mixed bag inside the U.S. market with U.S. technology, the Qs, in the green and among the strongest of all sectors, and yet small cap value in the red getting absolutely smashed. And then much of the U.S. below the database average, and the S&P 500 still above average at 66. So the U.S. right now is a market of markets. There's not one strong dominant theme. There are some minor plays that can be um, pursued, but this is certainly sector sampling right now rather than just broad U.S. market, in my view. The alternate asset classes like oil, treasuries, U.S. real estate are showing the way ahead. Only silver is really lagging in that regard. Europe and Asia are both mixed bags, and you can see the leaders and laggards by color there. Latin America and Brazil, you see just how bad they are with their scores of 6 and 16 respectively. Shifting over now to the Tortoise Daily Report, taking a look at the report going into Monday. So the market, in the market health check, this is looking at the S&P on a daily charts over the last 30 days. And you can see the boundaries of 10, 20, and 30 days of look back. The different yellow zones represent first the 1-day range, and then the 10-day range with highs and lows, and then the 30-day range showing the highs and lows. And so we've identified support and resistance levels based on the highs and lows of those look-back periods. And you can see that the dragon had risen rampantly up to and price followed up to 295 all-time highs, and then sold off pretty harshly down to 280 on the news of the potential trade war in China, and maybe just some profit taking after a really powerful move. Now, what's interesting to note is when you look at the MACD histogram in the 4 seasons, that summer lasted up till about the 18th of April, and that was when that failure to follow through occurred at the same previous rate. We started getting into fall, which tells you that in this middle period between 10 and 20 days of look back, there were signals to start being cautious about preserving the gains. And there was actually a 2-day sell-off in here that provided us some tactical opportunities, but were a reasonable place to take an exit after a beautiful move up from 250 to 295. When that rolled over in MACD histogram and came out of the Red River in the fall, you can see there were still opportunities to get out of those long positions around 290 before taking an additional 10-point haircut down to the lows at 280. Now, at the second yellow dot is where the signal line crossed the zero line and a short side bias is justified. Now, we are still in the winter, and what that means is that we don't have enough evidence yet that the gains of the last 4 days are a bottom and a reversal. This is still the potential for another sell-off. And in fact, if we saw weakness on Monday, Tuesday, and Wednesday, then this would be seen as a price that couldn't even get through the dragon and couldn't even get to the Bollinger Band mean, which has just started to roll over, and then this would be a pocket for a short side opportunity. So there are certainly opportunities for people to justify short side positions, and that's why we say this market is in a critical state, and that the short term volatility is the way to start playing this, build some positions with markets money, and then follow through overnight with markets money rather than taking swing positions. We do have the RL10 has reversed and is pointing its way back up. And so if it were to go back to the swing highs, we're still looking at the potential gains of an additional $10, which is about a 5%, 4% potential gain to the upside to retest previous highs. So there's room for tactical gains on either side of it. And so we use the 1-day highs and lows as ways to begin to get some directional sense of the market. So it only has to get below 285 to start seeing a resumption of the downside move. It really has to get above 289 to see any kind of follow through from the gains of last week. So again, tactical market that is in the winter on MACD histogram. So we're going to play it accordingly with shortened time horizons and being ready to take a bird in the hand rather than two in the bush. So we're looking for maximizing our intraday opportunities. Shifting to the summary, there are of indicators, again, no channeling overreaction signals. You can see the 10-day max pain. These are the ones that have sold off the most on a percent basis from their 10-day high. So it's weakness in the losers like Intel, Caterpillar, Dow, 3M, and United Technology. So 3 out of the 5 are in the basic materials that are slowing down because of the trade war with China potential. Really puts a damper on the business cycle, and so those basic materials and industrials are suffering accordingly. Intel and United Tech are really the outliers in what has been a very strong tech region. So those are ones that we would look at for potential turnarounds or more downside potential there. So if they were weak, and then if technology, which has been strong, becomes weak, then you would expect to see those losers to really lead the way downward. So that's why they're on our target for short side. In the ETF 100, what stands out to me is Brazil, metals and mining, and Taiwan. And then the S&P 100 again, Caterpillar, Halliburton, and Apple and Intel as potential weak side plays. In the Dow Tactical Summary, a half a dozen dojis were formed. We have plenty of symbols that test out on the auto framer at better than 2, 3, and even 5 to 1. Intel, 3M, and Caterpillar were big percent losers on Friday, and their ATR percentages are large. These make ideal intraday candidates on either weakness or gain. From extreme conditions come extreme results, and those are the big losers. So if I saw market weakness and weakness in their sectors, then I'd be looking to pile on the short side for those symbols to get the most out of an intraday short side opportunity. On the upside, Cisco and United Health actually both look pretty good on Friday and are reasonable ways to add to momentum. In the NDX area, you see that both Caterpillar and 3M had all-time breakdowns of previous trading ranges. So they made new 10-day, 1-month, 3-month, and 6-month lows. So this is catastrophe unfolding in front of our eyes, and there's much more momentum available to the downside in both of those. So if we saw the market being weak, those would be the first two places I'd look to get short. And that's why metals and mining, as we'll see on the next chart, is so attractive, because now you can get short the index that covers that area. So metals and mining, Latin America, Brazil, and oil exploration. So you don't have to be specific on which company targets. You can just play the sectors on the short side. And then on the long side, some strength on Friday in healthcare, utilities, and treasuries, and plenty of things that test out well on the auto framer. So we have opportunities here to do swing trading one day at a time by focusing on those key targets. On the daily pinch and stretch, only one symbol, Travelers, is above its river. Everything else is either inside the river or below, so that just tells you the magnitude and the breadth of the sell-off. The most negative Z stretches, these are the ones you can see that Intel is 16% below its Bollinger Band mean in the middle of the river. That's a 3 sigma adverse move. That's how painful the sell-off in Intel has been. And so there's either more pain coming, or that was an overreaction against fear. And then there's an opportunity to buy quality on sale. So that's one that we would certainly frame because of the magnitude of the stretch away from the middle of the river. 3M, Dow, Caterpillar, Latin America are all in that same boat. And so that's the areas that I'm going to be emphasizing because those are all in critical states. There's either more pain coming or it was an overreaction, and either way allows for a short, sharp move. The most expanded pinch boxes are the ones that have had the most sustained directional moves over the last 30 days, and you can see that Intel's width of the river is 6 sigma, and 3M is almost 5 sigma. That's how extraordinary the directional moves have been. So what that should tell you is that when you see things that are in a super pinch right now, like utilities, XLU, that once those things start moving, the size of that directional move can be really extraordinary. So we like to see things that are abnormally pinched, not many of them, and things that are abnormally stretched, because you're going to get sharp moves that come out of that extreme stretch conditions. So we'll be framing those for sure. The daily squeezes are things that have been very volatile over the last 30 days, but which had a relatively compressed and narrow range on Friday. And so a breakout from Friday's range, even if it's just an average range, gives us reward to risk ratios better than 2 to 1. So these are ways to play short term. It's almost like popcorn getting ready to pop, or springs that are ready to uncoil. This is clearly a 1 day opportunity trade. But when I see things like Amgen, General Dynamics, 3M, Procter and Gamble, these are all large cap stocks that are poised for sharp 1 day moves that will be on my short list. Shifting to the ADX stat. So this just looks at the strength of trend, and you can see that most of these things are untrending, so many of them in the yellow. That means the cycling of the market and the pullback and the resulting volatility, the lack of direction, leads to very low scores on ADX. The only one that actually has a strong positive trending score above normal is DBA agriculture, and so that may be one that we saw from an earlier note, maybe making its turnaround play. So there may be an opportunity to get on board a commodity which tends to be pretty directionally trending for swing trading. So I'll be looking at DBA with some interest. Next up, the Z scores of our regression lines. And their slope. So what I want you to notice in the bottom chart is that's the daily line price of the S&P, and you can see that the river, which is outlined by the red and the green, those are the boundaries of the river, has been generally sloping upward after that harsh sell-off. And there's been a really powerful move to the all-time high, but then the sharp China trade war has brought it back through the river and below, and now it's resting on the bottom of the river. Well, that's why the market is in a critical state. If it were to fail from here, we'd start looking for support levels down around 265 and 255 before the next free fall stops. So there's plenty of room to the downside if the bears have their way. And falling out of the river would be an indication that the bears are having their way. On the other hand, there's still a $10 or $15 move to the upside simply to test previous swing highs. So there's a 15-point move baked into the cake, easy to believe in either direction. And that means that this is a market that is in play based on short-term trading opportunities. So then when we look north, we see that the red line, which is the slope of the 90-period regression line, that last move of the previous 3 months was so strong that the 90-period regression line was a 3 sigma gain. That's how strong that 90-day move really was. That took it from 235 to 295. That's a 60-point move on 230. That's a 25% gain in the broad market over a 90-day period. That's an extraordinarily strong move. It's a 3 sigma move. So that pullback could be seen either as the times are changing or a simple sell-off to get rid of the froth. And exactly nobody knows what the truth is there. And that's what sets up this beautiful critical state for short-term trading. Now the black line in the top graph is the slope of the 30 period, which is the health of the market. And that has gone, again, from a 3 sigma move all the way back to below long-term average. So that 30-day sell-off that we've seen of the last 30 days has been relatively weak compared to long-term history. So that was a significant sharp sell-off. So we've got emotions built into this thing from many different time frames. Long-term buy and holders love this market and are looking to buy on dips, but shorter-term traders are seeing real significant weakness ahead and the potential for more pain. So they're going to be competing for directionality. And then the short-term traders who are taking advantage of the volatility trade here are just adding more fuel to the fire. So that's why this is a really positive market for short-term trading. And you can see that the thin blue line is the slope of the 10 period, and that just bottomed out and then had a nice rebound these last 3 days. So there's plenty of argument on both sides of this trade, and that's why I'm going to be a short-term trader and not have any positions overnight unless they're funded by intraday gains that I make as opportunity trades. And that's everything I want to cover about the market ahead. And I believe this is a market where you have to get the market right first rather than looking at the individual components because they are going to be easily overwhelmed by broad moves of market participants, which will swamp any tactical plays and individual targets. So get the market call right first, and then let that be your guide as we get through these troubled waters. So that's everything I want to cover from this weekend report. Plenty of preparation to do on our open positions and on targets of interest and getting the multi-time frame and multi-lens analysis prepared for the market. That's going to be especially useful this weekend, and that's what the guys here at the boot camp are going to be working on tonight and tomorrow as we develop our plans for the week and months ahead. So this is Ken at Tortoise Capital. Keep your risk measured and your powder dry.